Let me guess. You own at least 3 actively managed mutual funds. Your bank sold you some insurance products that you don't fully understand. And you follow a few finfluencers who promise to teach you wealth creation. But here is what nobody is telling you. This is exactly what they want. Banks want you buying more products. Fund houses are selling the India is different story so that you pay 2% instead of a lower fee. And finfluencers want you trading more because their incentives are tied to that. And guess what? It's working. 89% of all F&O traders lose money. 60% of all active funds are underperforming the benchmarks. Millions are locked into insurance policies that are horrible investments. You don't have a knowledge problem, you have a belief problem. And we are fixing that today. Today's guest has made it his life's work to call out myths. Neil Borate is the editor-in-chief of the Fynprint and has spent over a decade in personal finance. If there's someone who can separate investing facts from expensive fiction, it's Neil. So, great to have you with us, Neil. Thank you so much for making time.
Thanks, Deshna.
So, Neil, you've spent more than a decade covering personal finance. What is that one recurring behavioral pattern that you see amongst retail investors that keeps you motivated that I need to continue doing this work?
There are multiple ones, actually. One is chasing high return products without paying attention to risk, especially when those products are amplified by marketing, by clever marketing. So the most obvious example of this is futures and options trading. There's an entire ecosystem which constantly sells that to the people, and the idea that somehow you are smart and you're able to beat all of the algos and AMCs and people who have 10 times the resources that you do. Somehow that idea is sold to the common people, and they keep losing money through it. So number one would be that behavior, which is return chasing without any attention to the risk.
Fair.
Apart from that, there are some other trends which also apply, like chasing whatever's done well in the last 1 year. It's almost like an iron rule. People had thought they'd broken it because of the SIP culture that emerged from 21 to 24. But if you see last month's AMFI data, the flows into gold ETFs have equaled the equity SIP.
Right. So there is, I would, I'm making that this is a behavioral pattern that is pervasive, and somewhere fundamentals of investing are not really as strong as we want them to be, right? Got it.
Yeah.
You'd once said that you should be able to write down your portfolio even if someone wakes you up in the middle of the night, right? Let's
Yes.
explore that a little more. What did you want to convey there?
Basically, we overcomplicate our lives, and it's not a function so much of a desire to overcomplicate it, but that's how the system makes you behave. The most common example is the tax system, because when a particular product has a tax break, you go and invest in it, then that tax break gets taken away, and then you invest in something else, and then that tax break gets taken away, and then you invest in something else, and so you have this mission creep. But as just one example, there is also endless marketing that's thrown at all of us, right? It's like the financial industry is a giant mall, and it has a pervasive need to constantly show new sarees to everyone. And we can't, as human beings, we can't resist looking at them and maybe sampling them, and so ek kharid ke lete hain, dekhte hain. So that goes against. So I would say that most people who have portfolios above maybe even 10 lakhs will have a hard time if you wake them up in the middle of the night to tell you exactly what is where. And therefore, I think that people's portfolio should reach a stage where you can roughly at least jot that down. Even I would have a hard time telling you where everything is precisely, but I'm trying to get there. Like I try to stick to broader categories of funds, for example.
Right. So out of curiosity, Neil, how do you actually invest? Just
Yeah, sure. Happy to discuss. So basically, I have a uh 60-40 split. So the main split that I focus my attention on is the India versus non-India split. The reason why I do that, even before I look at equity, debt, gold, is because of my deep belief in country cycles and how those play out. And I think if I were to generate alpha in my portfolio, like meaningful alpha in my portfolio, it will come from the non-India side of it. I will be able to do better than the average Indian investor because I have informed myself about the world outside, which unfortunately most people are not informed through no fault of their own. It's the system doesn't tell them about it, and the system makes it hard. You can't easily invest outside. Um, so yeah, 60-40 India overseas. Within the India portion, it is roughly now it's roughly 20% equity, about 15 odd percent debt, and the rest in no, sorry, 15 odd percent gold and the rest in debt. So I'm very underweight India equity. Like, if you compare it to the generic portfolio of an Indian investor, I'm very underweight domestic equity. Um, and I'm very overweight international equity. So that's 40% of my portfolio.
Right. Very interesting. Thanks for sharing that. I'm going to dive a little more into the international part of it a little later in the episode.
Sure.
But yeah, thanks for sharing that. I'll move on to the next segment. This is where I'll state a myth that I've come across, observed, and we'll delve a little deeper to understand the actual degree of truth in it. I'd love to get your perspective on it as well.
Sure.
So, yeah, let's start with that. Yeah. So, the first one, these are basically misconceptions that are actually costing Indian retailers a lot of money. So, I'm hoping to get some clarity on that, right? So, the first myth that influencers are helping retail Indian investors make money, right? I've seen you seen a lot of your work which
Yeah.
talk about how this model works, but if you could just break it down into what
Yeah.
is the problem with their model.
Yeah. So it's not so much the humans themselves that I blame, but the system. So on social media, the algorithms amplify extreme headlines, extreme reels. They also amplify something that is entertaining and something that is easy to understand. And the problem is that finance, by its nature, by its true nature, is neither simple nor entertaining nor extreme. The truth is extremely boring that if you have a roughly 60-30-10 portfolio or a 60-40 equity debt portfolio, you're going to be just fine. You don't need crypto to make a huge amount of money. You don't need um, to get into gold at the right time and to get out of gold at the right time. Even if you have a Rip Van Winkle strategy, you have a static portfolio and you go to sleep for 40 years, you're going to be just fine. And that doesn't sell on social media.
Right. I think in continuation of that thought, right? You had stated that YouTube is India's largest advisory platform. I see that generic LLMs are kind of taking away the title, and it is a scary thought that people do rely on this mechanism. What do you see next happening in the next few months, years, and how
Yeah,
should
so sure.
sorry, how should someone looking out for genuine advice evaluate a platform?
Yeah. So you're right, the direction of travel is away from social and towards AI. It will take time because finance is driven by bonds of trust and habit, and that shift will take its time. But it is equally dangerous in a sense because we don't know what's behind that AI selection of stocks and ETFs. Many of they are generic, as you said. Of course, I do expect that investment advisors, research analysts will evolve their own algorithm, their own AIs, and those should be of a better quality. So actually, if you think of um, delivering financial advice to the masses at scale, at low cost, AI is a great solution. Like a properly trained AI will do the job that would be unimaginable even 5 years ago, right? In 5 years ago, if you had to, if you were a bureaucrat and you were given the task, key every district financial literacy has to be 50%, and let's say number of SIP investors have to be 25%, you would have had to hire lakhs of people in all of those areas, in post offices and various parts of the country, all of which has cost. Even a low cost economy like ours, even a low labor cost economy like ours, building that kind of trained financial manpower is extremely expensive. um, and now all that is gone away. Now with AI, you can have a 10-member team sitting on Mumbai and still serve crores of people.
Right. So, if someone
And
was
when I say Mumbai, I'm a little biased. You can be in Bangalore or anywhere else in the country.
right. So, if someone wants to evaluate, if, like you said, right, it's possible that each of us in different institutions could train their own model. For financial literacy is one thing, but I eventually see it'll become like a selling engine itself. But if I were to evaluate as a user, as a retail investor in India, that this is a genuine advice for me or not, how do you have some elementary checklist that it should pass?
That an AI should pass.
Yeah.
Um, I think basically just two things. One is that it should be developed by a regulated entity, or at least an accountable entity. So even if, because I do see a lot of influencers will get into the game and they will not get regulated, or media houses will get into the game and they will not get regulated. But at least if there's a reputation to protect, there is a chance that it should not go crazy. The other thing is the base of the model should be transparent and exposed to anyone who wants to check. Because ultimately all models are built out of training and built out of something that some human being has written down as the base rules for it.
Right. I think fair points, very interesting take on that. Neil, that you are also a content creator, right? How do you manage to strike a balance between giving credible advice and avoiding any conflict of interest?
Very difficult question to ask because it is a very difficult trade-off. But I think over the last 7 years as a journalist in Mint, I have been lucky because I've never had to write posts to earn a living, like to get advertisers. Right, I got a salary every month, no matter what, and that allowed me to build an audience which is also that discerning. So there is an old saying in content that first you make your audience, and then your audience makes you. I have reached a point where my followers will catch me out at the snap of a finger. If I say something that is obviously not in the public interest and obviously riddled by some conflict, I will get caught out immediately. So I think more than anything else, they will ensure that I stay on the right side of things.
Fair. I think that's something that you've built over a long period of time, and thanks for sharing that. Yeah. I'll move on to the next myth. Active funds are better for India because our markets are inefficient. The classic argument, this is a classic argument, the RM says it, advisors say it,
Yeah.
analysts say it. But what does the actual data say?
So I used to religiously follow the Spiva report every 6 months when it used to come out. Now, unfortunately, what happened, I think about a year ago, is that S&P 500 and BSE had a breakup. Like they had a collaboration and that just stopped. And then Spiva moved to a different set of indices. And so that created a data challenge. Like suddenly you had the active funds being compared to a different set of indices altogether. So so my information is a little bit dated because post that I'm not using the more recent ones, but before that, it was kind of quite clearly established in multiple Spiva reports that at least in the large cap space, there is sustained underperformance by active funds. Mid and small cap are still toss of a coin. So 50-60% kind of rates of funds beating their benchmarks. Um, so therefore, do I have a conclusive answer to that question? Answer is no. The data will keep, I think, as our market matures, it should lean in the way of passive, but possibly we are not quite there yet.
Right. Fair. I think my next follow-up was about, how the large cap active funds are underperforming, but you answered that. So I'll move on to the next thing. For a retail investor, suppose saving 10,000 rupees a month, how would you recommend going 100% passive, or is there a number? How should they think about dividing it amongst active and passive funds?
I think more than active and passive, it's really important to stick to broad categories of funds, such as multi-asset or flexi cap on the equity side, or at least multi-asset is not 100% equity, but close to equity side. So I'm saying this because typically what happens to a retail investor, he or she is told by an influencer that, oh, you should have three small cap funds, two mid cap funds, one large cap fund, and then every 6 months some new sadi is presented and marketed to that guy. He goes and buys another fund and creates mission creep and taxation. So before I get to the active versus passive part, actually I want to strongly spell out my belief in broad-based category, even if it means giving up a bit of alpha, even if you had a theoretical genius brain that could pick the best small cap fund and the best mid, and therefore collectively you should be beating a flexi cap, even after paying all the taxes involved in rebalancing. I would say it's not worth chasing that. Stick to the larger categories. Now, within these two categories, should you do active or passive? I think both of these need different psychologies. So, by the way, there are passive funds also in the multi-asset category and also in flexi cap, and active in both. So it's not like you are deprived of choice. But coming to like, how do you choose? So for somebody who has a relatively weak discipline power, someone who's going to be swayed by their active fund coming down, the performance coming down, somebody who's not able to pick these funds properly, passive is a no-brainer. But I think it is still possible for someone who has little bit of research or advice to actually still go the active way until the data proves otherwise.
Right. So fair. I understand to look at it from a more bird's eye kind of view thing, instead of bifurcating between active and passive.
Exactly, because otherwise I would have said, oh, do the large cap in passive and do the mid and small in active, and then who's going to rebalance it, who's going to pay the taxes? It's just easier to do fewer funds which are more broad based.
Absolutely, I think that absolutely resonates. All right, I'll move on to the next myth. Fund managers are stock picking geniuses who can beat the market.
So the thing about finance is, a statement can be incorrect and still be correct at the same time. In the sense, it can apply to a few people, but not apply to the vast majority. So, yes, there are geniuses. I have seen them in action. I have seen them deliver multi-year periods of beating the benchmark and beating the category. But what are the chances that the average investor is able to identify them? Mathematically, has to be less than 50%, has to be toss of the coin or lower, because there's inefficiency. And so if your chances are not that high, then don't aim for that. Just aim for a fund which sticks to the top two quartiles over long periods of time, which is consistent, and you'll be just fine.
Right. A follow-up on that, right? Identify, yes, you'll, as a retail investor, I would have to identify that hero fund manager. In your experience so far of talking to so many fund managers,
Yeah.
if you were to give me an honest answer about really are these um, as they're marketed, as genius as they are marketed, or is it like blown out of proportion at times?
No, it's always blown out of proportion because there's a lot of hero worship that we do in India across all walks of life. And the AMCs, it's in their interest to amplify that individual and his or her amazing stock picking abilities. But there is at the core of it, when finance is math, it's returns. You can't fake returns, and you can't fake consistent returns either. So take it all with a pinch of salt, but some of them are pretty good at their job.
Right. All right, I'll move on to the next myth. More research and stock picking will make me a better investor. I think I've also been guilty of this. I thought if I read a lot of reports and do a lot of stock picking myself, I'll be able to crack it eventually. I understand that you've studied Rakesh Jhunjhunwala in great depth. What's your take on it? Is reading having knowledge enough, or is there some secret sauce that we tend to miss as retail investors?
Hmm. So, unfortunately, most people don't even go that far when it comes to reading reports and doing the hard homework. The direct equity investors, the usual version of research is pull up a chart, see the squiggles going up and down, draw a trend line, and buy. Right? That is research for them. Um, so so clearly the answer is no, because the odds are stacked against most people. And it's even if you had 12 hours a day every day to read fundamental analysis, to do deep research, you had the training, even then you have to compete against machines and teams of people who have access to a lot of computing power now. So it's just not worth, uh, for most people, it's not worth the attempt. But most people don't even go there. Like they stop many miles before that. Like दो तीन charts पढ़ लिए, कुछ buy किया, and if it goes well, तुक्का लग गया, तो you think you're a genius, and then you go and buy more until the market eventually shows reality.
Right. Don't you think this is going to get a little more sophisticated in the coming few months, years? You know, you just need to crack the right prompt and all the research would be done. Do you say it that way?
Don't entirely dismiss AI, because it's a new world that we are entering, and the guys who know how to prompt well will have an edge in all walks of life, not just equity research. But that said, it's not going to be a holy grail. At best, it'll give a little bit more over short periods of time, but then the market will wisen up.
Right. Just fair. I'll move on to the next myth. The part about international equity we were talking about, I'll continue with that.
Yeah.
So, the myth is I can't invest globally because of RBI limits or because it's too complicated. So, with LRS, feeder funds, all of
Hmm.
these options available, how would you suggest a salaried professional who has limited time
Hmm.
start
Hmm.
thinking about international exposure?
Yeah. So I would first of all sympathize with that person, because this system has made it hard, more hard than it should be. We had feeder funds that were so easy to access for so many years, and back then nobody bothered. Um, so for someone who maybe is just doing like a 10,000 rupee SIP a month, feeder fund is still possibly the only option, because the other two options, which are Gift City and LRS, those need at least a $5,000 ticket size in a year. And that's not going to be possible for like the 10,000 rupee SIP guy. So, so for him, feeder funds, and hopefully they'll continue to last for a while, at least more. And जब वो सब बंद हो जाएंगे, तब either the $5,000 ticket size comes down in gift and makes it more affordable, or really you have no choice. Maybe at best, gold is a proxy for at least rupee diversification. Um, for someone who has a little bit more savings, so who can do the $5,000 a year investment, then there is a plethora of options. So Gift, of course, gives funds run by AMCs and fund management. The other is LRS, and that gives you access to US markets, the mother markets of the world. ETFs that can let you invest in some of the world's best, most innovative companies. So they should check them both out. It's a very personal decision which of these two to go for, because there are tax advantages to Gift, tax compliance advantages, but there are also advantages to doing it yourself. So it's a very personal choice.
Right. Just to continue on that thought, right? Suppose I have $6,000. Is the India growth story enough for me, or should I actually make a conscious effort to go international, get some international exposure?
So, however one looks at it, like let me just take the most optimistic case for India, that we will continue to have 8% GDP growth, that whatever has happened in the last year and a half is an aberration, that our equity markets should give 12% in the long term at an index level, and therefore mid and small should give 15%. And I'm laying out the most crazy bullish case that is there. Does this mean that you will not have periods of stagnation or bad returns? And I think I can say that with surety that you will have those periods, even in the most bullish scenario. Now, if that is going to be the case, then question is, do you as an investor have the energy and the mental resilience to weather those periods? Some people do, but a lot of people don't. And thing is, we can't anticipate that until you've lived through it. And thankfully, being a millennial, like I've seen at least a few cycles play out. Those who've come in after 2020 or 21, they've seen only an upward cycle and maybe like 1 year of stagnation. So just for that reason alone, like I'm saying for a second, I accept bullish case. Just for that reason alone, it makes sense to have a global exposure. Now, my base case is not the bull case for India, because the way I see it is, in this, if AI is the next industrial revolution, if AI is not just one sector, it's not just one trend, it's changing everything that we do. India is nowhere close to the forefront of it. It's a two-country horse race. And if you're not in any of those two countries, then chances are your portfolio is already at a disadvantage. Already it's going to take a hit. And we're seeing this play out in IT. If you look at the manufacturing side of it, right, we don't make semiconductors. There also we are not part of this. Every which way, like if somebody were to ask me what is going to be India's engine for growth in the next 5 years, I don't have an answer. I don't think most people have an answer. It used to be IT, but IT is under a lot of pressure right now. So my base case is not the bull case. I'm saying even if there's a bull case, there's a case to go abroad. But my base case is that there's a good chance that India will actually underperform the major economies of the world. It may not be the US, because US is richly valued. There are AI and tech has gotten very expensive, but chances are that India does not do as well as whatever replaces. So if you think of the world index today, US is 60%. There is a chance that China takes market share from it. There is a chance that EMs more broadly take market share from it. Is India going to be one of those EMs? Maybe not in the forefront of them. Not so far, at least. The last 1 year has shown that we're not there.
Fair. I'd actually take this as a good wake-up call. So for everyone hearing into, thanks for that. Yeah. All right. I'll move on to the last myth. My bank's insurance policy is a good investment plus tax saver. I want to do this a little differently with you. Why don't we do a little math, right? Suppose with someone has 1 lakh rupees per annum of corpus assigned towards this. Let's work it out, what returns would a ULIP give versus a term insurance plus a mutual fund investment, a combination of that.
So depends on the charges in the ULIP. ULIP state off the bat deducts a bunch of things. So typically there is a policy administration charge as a premium allocation charge. There is a fund administration charge. There is a mortality charge because there is insurance involved. So when you apply all of those charges, let's assume that the equity market return is 12%, and those charges are eating out, I'm being conservative here, 2% every year from your return, right? So you're down to 10 in a ULIP. Whereas in a mutual fund, I'm assuming, let's say you do an index fund, so 12 ka more or less 12 ही रह जाता है. Few basis points get taken out in expense ratio. Now, insurance is difficult to compare, but I'm assuming that the insurance, the mortality charge is equal in both. Again, I'm being super conservative. So, come se come, like even loading the dice in favor of the ULIP, the MF should be able to give you 2% more. And 2% more compounded over 10, 20 years is a big chunk.
Right. It would probably, if the amount that we started off with, right, 1 lakh per annum, it would compound to a few lakhs, 2% over a 20-year period. So, yeah, definitely the latter would be a better option, where you buy term insurance and invest the remaining in a mutual fund.
Yeah. And this is making a lot of assumptions. So the thing with ULIP, probably the biggest thing with ULIP is because you are locked into it and you can't switch out of it, there is almost no pressure on them to perform. Once the money is in, it's in the bag. Mutual fund guys constantly on tenterhooks. So that's a pretty heavy hidden cost.
Right. This is absolutely a very interesting point that you just made, right? So your money gets locked in on top. It's another disadvantage that is evident on the surface.
Yeah.
Fair. All right. I think now that we've bust quite a few myths, let's rebuild a little conviction as well for someone thinking about building their own portfolio today after listening to this episode. If you could just chart out a small blueprint on how they should start off thinking about their portfolio.
Sure. So, as I said before, keep it really simple. So maybe just do 2 or 3 funds to begin with. Assuming that there is some short-term goals in place, you first build an emergency fund, 6 months worth of expenses, which is put into a liquid fund or an FD. For the short-term goals up to, let's say, 2 or 3 years, you put that money into a debt fund or a hybrid fund, which is heavily tilted towards debt. And then beyond, let's say, again, these are very rough estimates, but beyond a 3-year period, you can look at multi-asset funds as your wealth builder. And the multi-asset will have everything in it. It will have debt and gold. And to pick a good multi-asset, you have to make sure that it's actually trying to give you the advantage of multiple assets. So if it only has naam ke vaste debt, then that's not the fund for you. If it has a static rule that it has to be 80, 10, 10, then that's not the fund for you. So pick the right multi-asset, and ideally should have some level of global stocks in it as well. Some of these funds do, thankfully. And that would sort out the vast majority of your portfolio needs. Of course, insurance, you should take, alag se, health and term. NPS is another nicely taxed advantage product that you should do. But this simple framework would cover, I would say, 90% of bases.
Right. Thank you so much for articulating that so clearly. I'll move on to the last segment, the rapid fire. You could just answer in a word or a sentence. Sure?
Sure.
All right. The best mutual fund category for beginners. I know the answer, but I'll let you say.
Multi-asset.
Yeah. The worst financial product being sold today.
Endowment insurance.
One fund house that you absolutely respect.
This also you might know, it's Parag Parikh.
Yeah. Uh, Gold in the portfolio today.
As important today as it was before, but people should not go overboard in it.
Right. The last one. One book every investor must read.
People don't read books these days, so I'm going to say a name and it's going to be royally ignored by everyone. Um, so I'm going to refrain from it. I'm just going to say, we're in the world of AI, so maybe as you engage more and more with AI, pick the responsible ones.
Fair. Interesting answer. Thanks for that. And yeah, I thank you so much, Neil, for this conversation. It's been a pleasure speaking with you. Very interesting insights. Thanks again.
Thanks, Deshna. Thanks for having me.
That's Neil Borate, the editor of the Fynprint. Someone who's made a career in truth telling in an industry that profits from confusion. If you believed these myths too, you're not alone. But now you know better. Please remember, you don't fail because you don't know enough. You fail because you believe the wrong things. Until next time, this is Deshna here signing off from Money Without Myths.